Chapter 13, just briefly. I didn't get as in depth as I like to, but I didn't have as much time today. But what I did learn is, as I mentioned yesterday, chapter 12 was about the purchasing process. So today was the next step, the accounts payable and cash disbursements process. And so when a company decides they want to buy something, the first thing they do is go through all their purchase orders and purchase requisitions, and then that information moves to accounts payable, and then that information moves to cash disbursements. That's where it ends. So yesterday I touched on control goals and control plans. The control goals will be the same. That would be effective operations, complete input completeness, input validity, and input accuracy. But for accounts payable and cash disbursements, there's some different control plans to achieve those goals. So I'll just touch on a couple. One that I learned about today that was originally slightly confusing to me was independent validations of vendor invoices. And so when I hear the word independent, I'm not identifying that just means independent, standalone, on its own, separate from the other portion. I don't know what I'm picturing, but today it like clicked. It's like independent. It just means separate. It has to be separate, completely independent from the other part of the process. So independent validation of vendor invoices would cover the person who's recording the vendor invoice from receiving the PO report. That must be separate. So whoever's recording the invoice, so whoever's putting it in AP, that person has to be a separate person than the one who created the invoice. So AP would not create the invoice. Does that make sense? I hope that makes sense. That's my understanding, briefly. The next thing would be another control plan to achieve your control goals, such as input completeness, input validity, input accuracy. Those are your goals. And effective operations. The next control plan to help you achieve those goals, another one would be matching the invoice PO to the receiving report. And so the PO is at the beginning of the process, the purchasing process. When the company first decides they need some inventory or something, they would create a PO. So a purchase order detailing what they need from the specific vendor. The receiving report is at the other end of the process when the goods have been ordered and they're being shipped in from the manufacturer. So you always want to, in an effort to make sure that you have you're being billed for everything that you actually received, you want to match your invoice, your PO, to the receiving report. And so what you initially ordered in your PO, you want to make sure that's actually what the vendor sent to you in the receiving area. And you want to match that before it goes to the warehouse. So that's another control goal. And then another one with this independent that was confusing me. Independent authorization to make a payment. That means that the accounts payable clerk who record and create the payment, that is a separate person from the one who executes the payment. So this is what I always try to relate the material to like my particular company, and it's a little hard to do that because my company doesn't sell like physical inventory products. So I'm always like reading this because this is more for like warehousing inventory, like companies that sell physical items or companies that are purchasing physical items for resale or that need things like supplies and things. So I'm always trying to relate it back to my company. So the independent authorization to make a payment would be that the person who is the accounts payable person who is putting the payable in the system, recording the payable, is different. It's a separate function from cash disbursement. So the cash disbursement is the person who's actually releasing the funds. So those should be separate functions. So the person who's putting the invoice into the system should not be able to also release the funds, because this is where fraud can occur. Because if that person decides that they want to pay themselves and their company, they can create an invoice for some fictitious items from their fictitious company and then pay themselves. So you always need a second person. You need one person to input the payables, and you need one person to actually disperse the funds, disperse the cash to pay the invoice. That's how you catch them. So then there are a couple of, another control would be reconcile your bank accounts. And that's something that everybody should be doing. And it's fairly simple. That's something we should be doing with our own personal bank accounts. So it definitely should be done by, a company who's selling a product. So what I wrote down for that is you always want to match your bank statements to the cash disbursements to ensure that the bank made only authorized and accurate payments. So that means that whatever cash disbursements you had, so AP put all the invoices in, the cash disbursement person sent all the money out to pay those things. Then you want to come back when you get your bank statements and you want to look at what those cash disbursements that went out, you want to make sure that those match what's on your bank statement. So you want to check to see if there are any extra payments that came out, potentially by fraud, any duplicates, that the bank pays something twice. You want to check all those things. And so they kind of went into greater detail with checks, because a lot of companies use checks. Some of your bigger manufacturer companies probably use for their payments maybe something like EDIs to reduce on paper and stuff. So EDI is like electronic transmittal of your checks from system to system. It's pretty efficient, and it reduces your paper of physical checks that need to be dispersed, like sent out. So a couple of controls for paper checks, which I learned this evening, or ways to make using paper checks more efficient, prevent fraud, duplicate payments, them getting lost, things like that. A couple of controls would be if you are using physical invoices, you always want to mark those invoices, like stamp them, paid or void. So someone will know that they've already been paid and they won't be like submitted twice. And then another control is when your company actually uses physical checks, like my company actually prints physical checks. You always want to have control over your check stock. So your blank checks that are watermarked should be locked up and secure. They shouldn't be laying around, because I can easily snatch one of my companies, since we use physical checks, snatch one of those checks, come home to my laser printer and write myself a check. And it's very easy to do. Another control would be to automate your signing, so the signing of the checks, so it saves time and the authorized signatore's fingers from signing. Because if you're signing like we don't have hundreds of checks as my job, but there are companies that literally could be sending out hundreds and hundreds of checks multiple times a month, depending on how big of a company it is. So when you automate signing the checks, it just relieves your authorized signatures. Another control you could put into place to help prevent fraud with checks is duplicate signatures. Like my company uses duplicate signatures. So my executive director has to sign, and then some of the other authorized signatories sign as well. Every check. No check should be, and the bank also knows that no check should be honored that comes into the bank that does not have both signatures. And they, of course, have a list of names of authorized people who can sign the signatures and their signature on file. So another thing that would help with fraudulent checks is having a time limit on those checks. So a time limit in which they're valid. And I believe most, at least personal checks, probably corporate checks too, are like 6 months, 180 days. So its check is only valid for 180 days. But what I learned in a previous class I took, which is a law class, is that the bank always wins. So regardless of whether or not your check says 180 days, the bank can honor that check in good faith and cash it after that 180 days. So you always want to be cognizant of that. And that's why you always want to do your monthly reconciliations, to make sure that you know what's outstanding and which checks haven't cashed. And you'll be able to know which checks are coming up on that 180 days, and you can follow up yourself proactively before that time limit passes. The 180 days passes. So yes, so while most checks do say 180 days, void after 180 days, just know that legally speaking, the banks have the right to honor that check in good faith after that 180 days. So just because you tell them, even if you tell them to put a stop payment on it, they can still honor it in good faith. And that I learned in my law class, so it's fact. So let's see what else. There's another couple more things you can do. Oh, okay. Things that can help in your control plan is positive pay. My company actually uses positive pay too, and I wasn't too informed in it because I'm not a part of necessarily the AP process in my company, but I know we have it, but now I understand clearly what it is. So positive pay is when something that the bank offers your company, where your company provides every single check, like the invoice number, the amount, what it was for, a list. Every time they issue a check to someone to pay something, they let the bank know. And so the bank, every time they receive a check from your company, they run it against that list. And so if it's not on that list, they don't honor it, which is another, just it's a great backup plan, just in case your other controls are not successful or some are missing. And so let's see what else. Some other controls that I learned about today for accounts payable and cash disbursements are, oh, also payment due, like a tickler file. And so the tickler file is more of a proactive approach, and it ensures that your payments are made on time, because you can monitor your all of your open POs, for example, and all of your open receiving parts. So every report that every PO, purchase order, that your company puts out, you would keep a tickler file on that. And so periodically you would check to make sure to see, you would do an aging to see how long that particular PO has been left open in your file. And those are the ones you would follow up on. The same with the receiving report. So you would keep a log, you would compare your receiving reports and your POs just to make sure that you've received everything that your company actually ordered. So another thing, run to run report, that's something new that I learned. So run to run is all of your input totals should always match your output totals. So however many input invoices you put into the system, that should always match the number of like receiving reports. You'd have packing slips, picking packing slips that you would come back, because every invoice is what you wanted to order. Your packing slip is what actually came in, plus or minus any corrections that your employees would make in the receiving department. And so those should always match. They always total out to the end. If they don't match, either your accounts are off, the company's billing you for something that you did not receive, or they aren't billing you something you did receive, or you're being billed for something you never ordered, or you ordered something and it never came. And so those are always things you have to match up. And then the last one I'll talk about tonight, and I'll let you all go to sleep. Or if you're watching this the next day, you're probably not going to sleep. I'm going to go to sleep. But you have a cash planning report, and that's something I just learned about. That is done by, the cash planning report is, you run an aging of everything that's in your system, all the invoices that need to be paid, to ensure that your company has the appropriate cash reserve on hand ahead of time, before your invoices are late and you miss your opportunity to take advantage of like cash discounts for prompt payments and things like that. So I think that's all I'm going to share for today. I learned a lot today about the control plans, and the control plans from today complement the control plans from yesterday, because in your full process there's two types of processes. There's order to cash and purchase to pay. So order to cash is the customer. The customer puts in their order all the way up, everything that happens up until they pay you, the company, for the services or goods or services. And then purchase to pay is your company, what your company orders in terms of supplies and inventory, all the way from your company ordering things they need to resell or use in the process, like cost of goods sold, all the way to them paying for it. So your organization paying its bills, essentially. And so all of those things, those type of orders, in the purchasing process, correlate with these control plans that we've just talked about today, because first you have to put in things you want to purchase, and then you have to set it up to pay it, and then you have to disperse the cash to pay it. So it's all related. So I hope you enjoyed this summary today of the accounts payable cash disbursement process. And I will be back tomorrow with the next video on what I studied tomorrow. I think maybe tomorrow I'm going to focus on chapter 9, which is implementing the system development lifecycle, which I think will be easy for me because I took a lot of those classes in undergrad. So I kind of understand that whole process, but still got to study it. Make sure I'm ready for my final. So thanks for joining my journey. Please subscribe down below hit the notification button, and I will be back with more videos.